In this video I am going to talk about an important subject regarding trading psychology that is usually not approached at all by experts. While the great majority of retail traders seem to be only worried about the perfect technical setup, there is a silent psychological trap devastating more than 90% of traders in the market. This psychological trap I am referring to is called the spectral point of no return. Imagine that your emotions in trading live in a spectrum where you have negative emotions on one side and positive emotions on the other. The middle of the spectrum can be characterized as the neutral state of mind in which traders start their trading analysis. On the negative side of the spectrum, we have emotions like fear of losing money, anxiety, and hopelessness in the trading strategy. On the positive side of the spectrum, we have emotions like confidence and mild ambition. Surprisingly enough, the point of no return lives on both sides of the spectrum. In other words, there is a point of no return in the negative side of the emotional spectrum and one in the positive side as well. The correct application of trading psychology aims to keep traders between these 2 points and always tending to the neutral state of mind as much as possible. To avoid passing both points of no return in the emotional spectrum, the retail trader needs to understand the foundations of trading psychology. These foundations are built upon the way in which the human brain works while facing economic decisions that involve time, which is precisely what happens in the markets. One critical component that drives the trader to the extremes of this spectrum is called emotional cascading effect. This emotional cascading effect can also be viewed as a positive feedback loop. In other words, when a trader experiences a bad emotion for whatever reason, this emotion tends to facilitate the appearance of a worse emotion to the left of the spectrum. As the trader gets closer and closer to the left part of the spectrum, the more likely it is that he will surpass the point of no return. This idea gives rise to the concept of spectral emotional gravity, which is the worst enemy in all trading psychology. As you can imagine, the same analogy works to the right side of the emotional spectrum. For example, when a trader is in a winning streak in the market, he will gravitate towards the right side of the spectrum. However, due to the existence of the spectral emotional gravity, if this trader is not careful, he will surpass the positive point of no return, which is just as deadly as surpassing the negative point of no return in the other side of the spectrum. If a trader surpasses the negative point of no return, he can display extreme anger and frustration, which can be translated to the complete breakdown of his trading plan, and as a consequence, the complete loss of his capital. If the trader surpasses the positive point of no return, he can display extreme overconfidence, which will also disrupt his trading plan and result in total loss of capital. The existence of the spectral emotional gravity has its roots in the biological evolution of life. In other words, the way the human brain calibrates our emotions in real time is based on evolutionary reasons that have nothing to do with trading. To understand how to avoid these obstacles that all traders must face, you must be willing to dive in deeper trading psychology concepts. If you enjoyed this video, don't forget to subscribe to our channel and to leave your feedback and your like below the video. Don't forget also to activate the notifications to get real-time updates of the channel. If you have doubts about any aspect of the Forex markets, don't hesitate to contact us at any time. We will be more than happy to guide you. I hope you learned something new and useful. Thank you very much for watching and I hope to see you in the next video.